I've invested $700 of my own money in Uber stock. While most people are panicking about the crash, I believe it's created a massive opportunity. And I'm going to show you why I think Uber stock could 5x from here. First, I'm going to show you why the stock is down over 28% from its all-time high. Autonomous vehicles, better known as robotaxis, are viewed as a major threat to Uber's entire business model. The basic idea is that AVs will replace Uber's human drivers, leading to a shortage of supply on the network, forcing consumers to look elsewhere for their mobility needs. Tesla was one of the first challengers, but their full self-driving technology has failed to meet expectations. Then a new challenger emerged. Alphabet, the parent company of Google, was secretly building their own AV competitor called Waymo. Out of all the companies developing autonomous vehicles, Waymo is by far the market leader, completing over 500,000 weekly rides. So where does this leave Uber? Uber did have its own AV program but sold it for $4 billion back in 2020. Since then, Uber's CEO Dara Khosrowshahi has been pursuing an interesting strategy. Rather than developing their own robotaxis, Uber would support dozens of AV companies operating around the world. The idea is that once these AV companies produce a working product with regulatory approval, they would partner with Uber, serving consumers through Uber's existing platform. And according to Dara Khosrowshahi, Uber sees AVs as a long-term large opportunity, framing it as another $1 trillion TAM and not a winner-takes-all market. Now I'm going to give you the 3 main reasons why I'm bullish on Uber stock. So the first reason why I'm bullish on Uber stock is the growth and continued strength of their core business. In their last quarter, Uber's monthly active platform users grew 17% year over year to 199 million, and the number of trips completed across both mobility and delivery grew 20% year over year to 3.64 billion. That's in just a single quarter. Overall gross bookings, basically the value of orders across Uber's platform, grew over 25% year over year to $53.7 billion. And in their recent quarterly earnings call, Uber's management team said US mobility growth accelerated faster than overall mobility, and management expects further US acceleration in 2026. Mobility is Uber's rides business, and the expectation from management that US growth will accelerate further in 2026 is very important because it's one of the most profitable parts of the business. And it also suggests that AVs are yet to have any negative effect on Uber's market position. Uber's management says in markets like San Francisco and Los Angeles, their category position is higher than 6 months ago despite AV competition, and trip growth trends are improving. So in places where companies like Waymo are currently already operating, Uber is actually gaining market share. Uber's management also confirmed strength in their food delivery business. Delivery bookings grew 23% with grocery and retail as key growth drivers. Management say Uber is aggressively expanding in sparse markets, meaning suburban and non-core urban. As selection and reliability improve, mobility and delivery trip growth in sparse markets is running about 2x the growth of core urban markets. This is an important development. Uber is huge in major cities across the world, places like London, New York, and San Francisco. As investors, we might notice that and think Uber's growth can't possibly continue at the current rate. Surely it will slow eventually. But in reality, there's a huge white space in the suburbs and less densely populated urban areas for Uber to grow into. Why shouldn't residents located in small towns of, say, 100,000 people also benefit from Uber services? I think that will be one of the key growth paths for Uber over the next few decades. The second reason why I'm so bullish about Uber is their Uber One subscription service. It reached 50 million members in their latest quarter, up a whopping 66% year over year. In the latest earnings call, Uber's management said the Uber One membership base grew from roughly 30 million to 50 million in a year. That's about 20 million additional members. Benefits of the Uber One membership include no delivery fees and mobility credits, with economics viewed as structurally better than competing local memberships. What Uber means when they say their membership is better than competitors is that the unit economics are superior, because Uber's membership benefits are designed around high-frequency, low-cost incentives. For example, free delivery doesn't really cost much for Uber to offer because that mostly goes to the courier anyway. But for the customer, it drastically increases the perceived value of their membership and encourages them to order more often. That's why Uber's management team can confidently state that Uber One has structurally better economics than competing local memberships. And Uber is introducing new benefits like 10% Uber credits on hotel bookings via the Expedia partnership, additional 20% discounts at a rolling set of 10,000 hotels, and no fees above a $60 basket on grocery bookings. So due to Uber's scale and their unique advantage of operating a rides and delivery business, they can partner with companies like Expedia to expand member benefits. The reason why hotel partnerships make so much sense for Uber is that more than 1.5 billion annual trips globally are outside the user's home city. What do people need when they're away from home? Accommodation, for example, a hotel room. Perfect synergy. The third reason why I'm bullish on Uber is the huge opportunity opportunity presented by autonomous vehicles. As I mentioned earlier, Uber sees AVs as a $1 trillion market. You'd expect a large market like that to attract many competitors, and the closest comparison would be the automobile industry itself. There have been hundreds of car companies globally since the internal combustion engine was first produced. What makes AVs so different? I think the hybrid network strategy that Uber is pursuing is the smartest way to go. Rather than competing with all the AV manufacturers and software developers, just open your existing network with 200 million monthly users to every AV company, ensuring that no single AV company can develop their own platform large enough to rival Uber. That allows Uber to maintain its valuable position between the customer and the driver, or in this case, the robotaxi. In their recent quarterly earnings call, Uber's management gave an update on the strategy: a hybrid network of human drivers and AVs where both human driver earnings and AV usage can increase. Uber say they have over 30 AV partners across mobility and delivery, and AV mobility trips grew more than 10x year over year. They're on track to be live with AVs in up to 15 cities by year end 2026, with more to follow. Uber's AV partners include firms such as Zoox, which is owned by Amazon, Neuro, Nvidia, and various international providers. This suggests that the market is wrong about Uber's vulnerability to AV disruption. Now we're going to look at the current valuation of Uber stock. Uber's PE ratio seems quite low at just 18. On a forward basis, the PE actually increases to 20, suggesting Uber's earnings will decline over the next 12 months. This is because Uber's trailing earnings were artificially inflated by the increasing value of their investment portfolio. Basically, Uber owns minority stakes in quite a few companies, and the value of those investments are included in Uber's GAAP earnings. So as an Uber investor, I prefer to look at a different metric to value the company. I mentioned in a previous video that it's smarter to use non-GAAP earnings to value Uber stock. However, I've actually changed my mind on this. I think it's more straightforward to use free cash flow. This can be distorted by Uber's insurance reserves, however, that only makes up around 10 to 20% of free cash flow. Also, as Uber's subscription business and advertising revenue grow, it will decrease the impact of their insurance reserves. So in terms of free cash flow, Uber currently trades at a 6.5% yield, which is pretty high for a company of Uber's quality. The higher the free cash flow yield, the cheaper the stock, and vice versa. Even when accounting for stock-based compensation, the free cash flow yield is well over 5%. If we take a look at Uber's free cash flow yield over time, you'll notice the stock is becoming cheaper and cheaper. And when compared to their closest competitor, DoorDash, Uber's free cash flow yield looks really cheap. DoorDash currently trades at a free cash flow yield of less than 1% when accounting for stock-based compensation. DoorDash is growing faster, but does that really justify a valuation 5 times higher than Uber? Next, I'm going to run you through my base, bear, and bull case assumptions for Uber stock. Using Qualtrics' DCF calculator, we can project the expected return from Uber stock over the next 5 years. First, we have my base case assumptions, which include 18% free cash flow per share growth and a 4% free cash flow yield. I think the 18% annual growth in free cash flow per share is incredibly reasonable. Uber's gross bookings alone are growing at 25%, and with Uber's margins expanding over time, that will boost free cash flow growth. Then you also have huge share buybacks. Uber repurchased $3 billion worth of their own shares last quarter alone. By reducing the number of shares outstanding, you increase the amount of free cash flow per share. So in my base case scenario, Uber stock would increase from around $75 to over $275 per share in 5 years. That's a 30% annual return, meaning the stock would easily 3x in value. Then in my bear case scenario, I'm projecting free cash flow per share growth of 14% and a free cash flow yield of 6%. In this scenario, Uber stock would still increase from $75 to $154 per share. That's an annual return of 16%. And those are my bearish assumptions. The stock still doubles. Now for my bull case assumptions. I've gone with free cash flow per share growth of 22% and a free cash flow yield of 3%. So in my bull case scenario, Uber stock would increase from around $75 to over $430 per share. That's a mind-blowing 42% annual return and a more than 5x increase in Uber's stock price. So since I'm so bullish about Uber and believe it's insanely undervalued, what am I going to do with my own position? Uber stock already makes up just under 5% of my portfolio. I am considering increasing the size of my position, possibly up to 10% of the portfolio. But the problem is, I already hold a lot of large positions in other big tech companies. So adding to my Uber position would further increase my concentration in big tech. That's not necessarily a bad thing, but when the market decides it doesn't like big tech for whatever reason, my portfolio would be dragged down substantially. So basically, due to portfolio risk management, I won't be adding to my Uber position unless I have new cash. But even with more cash available, there are a lot of attractive opportunities in the market right now in businesses that I consider even higher quality than Uber.